Welcome to the weekly update, where I'll go over the action in the market for the week of March 24th through the 28th, and then we'll see how things look for the week of March 31st through April 4th. Okay, another down week. Friday's session really did a lot of technical damage on the daily charts, and it's starting to spill over here into the weekly charts as well. I'll go through all of this, and you can see how some damage has been done. There's still hope. There are still some positive areas that the market could latch onto and start to go up from here. But the fact that we came down to the 200-day moving average on the daily chart, we bounced up from that, and then we came back down, that's pretty negative. Usually, when this is just going to provide support and this is a regular decline, we come down, hit some kind of a support level, maybe the 200-day moving average, and then bounce up, take off, turn positive, and go up from here. That's not what happened this time. And we're back down below the 200-day moving average again. We still have long-term support that's holding, but we're only 5 points above that long-term support. So if we have any kind of a down day in the upcoming week, it's gonna start to make our long-term support even look more negative as well. Okay, so some notes before I get started. The weekly video that you're watching right now is just one of many videos that I post every week, and they're freely available on YouTube and on Rumble. Now, I delay them being posted, and what I'm going to be starting is a service pretty soon where if you want to have access to them and you're not interested in the full program that I have, this will be a separate service where you can go in and just look at the videos. I'm playing with the idea of the newsletter that I want to launch. Maybe that'll be included as part of this service. It'll probably be through Patreon, and I'll make the videos available there. Right when they are available, I will notify you and you can go and look at them. The videos are designed to always be viewed before the day that you see on the video. So, for example, this video is supposed to be viewed before the week of March 31st through April 4th. The daily video for Monday, March 31st is meant to be viewed before March 31st, or at least before the close, because I really focus on the close each day, not the open. We just watch the intraday action. So right now they're available right at the close. And so that makes these videos out of date. But a lot of you still find value in them just when I make them public right at the close, and you seem to find some benefit from them. But if you want to use these videos as a way of helping you make decisions in the market and you want the information delivered to you quicker, excuse me, consider that other service. It'll be $20 a month. And the way I'm thinking of it now, it might change. So don't quote me to this. I'm just playing through some ideas that you'll have immediate access to the daily videos, the weekly video, the intermarket analysis video, the deep dive video, and the what to watch video immediately, right when they're available. And then you'll have access to the daily, weekly, and other weekly newsletters in either by going to a website or downloading a PDF. That's kind of what I'm playing with right now. The idea behind this is that maybe you don't have time to watch the videos every day. I have members in the program who can't watch all the videos that I post, and people are busy, and there's things that need to happen. And so what I usually recommend is watch or look at the daily newsletter first. That's pretty short. You can just read over it. I have like an introductory part that just goes over the highlights. And then below that is more of an expanded overview, but still it doesn't go into a lot of details. And there are charts that are included in that newsletter. Reading through that, that'll help you to decide, well, do I need to go in and actually watch the daily video now? So that I'm trying to be respectful of your time, knowing that you're busy and that maybe you don't need to watch the videos all the time, but you still get a little update of what's happening each day. And then based on where you're at, you can decide whether watching the video applies to you or not. But the daily videos are where I really put the hub of my analysis and commentary. The weekly videos, all the other videos that I do throughout the week, they're all meant to tie into the daily videos. And this is just one of those videos. All right, and then I kind of mentioned the daily and weekly newsletter. I have a number of those that I'm working on right now. They're mostly in rough draft format. If you want to receive them now, you don't mind them a little sketchy here and there as I work out different things to put in the newsletter and how it will look and so forth. Whether you want it as a PDF or you want to actually come to the website and look at that, that's available, but it isn't officially up and going yet. So there's going to be some changes along the way. And I'm looking for feedback as well from people. So if this is something you wouldn't mind participating in, and then saying, well, can you do this? Can you do that? Can you change this? Can you change that? Let me know. And I will entertain any feedback that you may have. I may not end up implementing it, but over the years as an educator, a lot of the things that I've implemented have come from student feedback. Well, now people that view the videos or watch the newsletter or, excuse me, read the newsletter, I want to have some feedback there because this idea that I have, it's not for me to tell you all the things I know. It's to get you information that you can find useful and practical, and you can use that to implement part of making your decision process. So, okay. Then there is a PDF just of the slides that you see right here. That's not the newsletter. The newsletter is separate. But some people find it valuable to be able to download this. It'll have all the slides on here. It'll have all the charts as well. I do have a full-blown program. Here's the link. It's also the top line in the description below this video. It's still free for the time being, and you're more than welcome to check that out. I do update pivot points on the community tab on my YouTube channel. And if you don't think those are important, just go back to Friday's session. Where we hit that low was right at a pivot point, and we were able to just kind of go along sideways. Now we closed at the low for the day, but these can be really helpful tools to know if we're hitting support, if we're hitting resistance, and I've just found them day after day after day to be very accurate and very helpful. And I post those right on YouTube, and they are available to you to look at. Also, I do have a private Facebook group, and it's not really active, not a lot of members, but if you want to come in and change that, you're more than welcome to do that. And I do post on YouTube and Rumble, but I'm really careful. They must have had a webinar or something a week or so ago. I'm just getting lambasted these days with all these social media experts, which are really nothing more than scams. And they tell me how great the content is and all that, and they watch my video and they're just blown away. Well, I provide an email address in the video, and so that tells me right there they're lying to me. They're not watching the videos. They're just blanketing as many people as they can with their little scam because they're not social media experts. They're trying to get you to pay into some kind of software that really doesn't exist or is really junky, but yet they just want to get some money from you. And I used to teach security for Microsoft, so I know the games, and sometimes I play around with them a little bit depending on what mood I'm in, but ultimately I go in for the kill there because I have absolutely no compassion for people that play those kinds of games. And I do post on YouTube and Rumble. I already mentioned that. Okay, let's go back and talk about this week's session. We were down 1.53% for the week on above average volume, which is kind of strange because every day this past week we were below average with volume. But yet when you look at the weekly chart, we're above the moving average. We are turning more negative now. We're taking a hit, and we're right at pretty long-term support, and we've already broken other support. So there are some real concerning things going on. Now, what we've seen happening over the last few weeks, and pretty much going back to the beginning of 2025, is we start to set up some kind of a downtrend, and then poof, we have a couple of pretty strong up days, and then that starts switching things back over positive. And just about the time things look more positive, then we have a big down day like we had on Friday. If you look at the daily videos for last week, we were actually looking more positive. We weren't full blown positive, But there were some signs under the surface that things were getting a little bit better, but that was all wiped out in Friday's session. So we're just not seeing an awful lot of follow through right now. We did get the core PCE that came out. That's the latest inflation gauge that we had. And the important number was actually as expected. But because there's many decimals after this number, it got rounded down last time where it got rounded up this time, and it's kicking up the year over year reading. And that's one of the reasons the market decided to freak out in Friday's session. We also had a consumer sentiment reading. Folks are just not real comfortable with things right now because of all the changes that are taking place. And that's why you're not seeing volume above average. That's why we're having a really difficult time of seeing some kind of conviction with the market either going up or we saw some conviction coming down, but over the last few sessions, we're trying to bounce, but we're not really seeing any magnitude behind that bounce currently. And interest rates they really haven't been that big of a problem. I mean, they're up over 4%. We're around four and a quarter, a little bit over that. I think a little bit under that actually. But it's if we get up to that 4.5% level with the 10-year yield, that's when it'll start to freak out stocks. And so that really hasn't been as much of a problem where it was maybe a month or so ago when interest rates were higher. And then there's growth concerns, economic concerns. Well, we had some economic reports this week that actually were not terrible. And so that, and then what they're doing, the analysts are coming out and actually lowering their forward earnings forecasts. Now, you may not think that's that big of a deal, but that's what drives stock prices. If a company is earning more money, it justifies their stock price going up. And they had pretty lofty projections going out into the future. They're still positive, but they're coming down from those lofty projections. And that's also putting some pressure on stock prices. And then anything geopolitical, whether it's Russia, Ukraine, Israel, somewhere else, all the things that are happening now with Doge and executive orders, and a lot of people love what's happening right now. They think it's the best thing for the US. Other people just, no matter what Trump does, they're going to hate him anyway. And so there's that real tug of war going back and forth there. And then there's also talk going back and forth of, are we going to go into a recession? We still don't have enough information to really know that. We're going to get the employment situation report coming out this Friday, and that will be rather telling. So far, with the weekly jobless claims and the previous employment reports that we've had, excuse me, employment's holding up. It's doing fairly well. But now, since a lot of these cuts are coming in, because most of the growth were government jobs. And what Doge is trying to do is go in and cut government jobs. And so that may come in and start to hurt the employment numbers, and maybe it'll end up sending us into a recession, but we just don't know that yet. Okay, and then this Friday, Chairperson Powell will be speaking the day that the employment situation report comes out. And when he talks, everybody listens. Okay, as far as our trend, we're still negative. It's not a confirmed trend yet because we're still below 20, but we're above the moving average and going up with the ADX line, and the red line is above the green line, and that means it's a negative trend. So, just some bullet points. It was a week of significant volatility. It was actually holding up okay after Thursday, and then it just went crazy in Friday's session with selling pretty much right at the open, going all the way into the close, and all the indexes ended up being down. The S&P is back below its 200-day moving average. Now, we were able to get back above that, and that was seen as something positive, but now we're right down here again, and that's not seen as positive. Then rising inflation, whether it's perceived or actually real, the market's concerned about that, and you have folks that are concerned about that. What are the tariffs going to do? Is it going to produce inflation? Is it going to throw us into a recession? This is change that's taking place. That some of this change goes back well over 100 years, and you may agree or disagree with it, but it's happening, and it's what most of Americans voted for. And there's probably some remorse voters, but at least you can say one thing that what was promised is what's being delivered. And but there's a lot of resistance to it. So it's going to take some time with the idea that there could possibly be short-term pain for longer-term gain. But to undo 100 plus years of the U.S. government moving in one direction and now trying to reverse and come back in a different way, it's going to take some time. There's going to be some pain that goes along that. And then consumer confidence, that came out on Friday, still pretty low there. And that was also given as justification for the decline. And then these trade policy uncertainties. We've got a bunch of tariffs that are supposed to kick in this week, whether it's April 2nd or April 3rd. There's some hope that maybe there's some negotiating going on right now. Maybe something can be done about that. And one thing that you can say is Trump's not afraid to go there, but he would like to get folks to the table, negotiate, and see if something mutually agreeable can be worked out. But if it can't be worked out, then yeah, the tariffs are going to go into effect. And believe it or not, the tariffs that are placed on U.S. products going to other countries are actually quite high. And then other companies are, well, we're the victim, we're the victim. Well, some of these other countries have very high tariffs on U.S. products going into those countries. And so in some cases, there may be reciprocal tariffs that are actually enacted. And then that could produce more tariffs on the other side and more U.S. tariffs. And that's why we call this a trade war right now. The consumer confidence showed the fourth consecutive decline, and consumer sentiment has also been declining lately. And then President Trump did announce a 25% tariff on imported passenger vehicles starting April 3rd. Of course, this is all due to change at any time if these folks are starting to negotiate. He also said reciprocal tariffs will go on for all countries, but the U.S. will be very lenient. I heard Trump speaking at one point where he said, I wish all these tariffs would just go away, but things need to be done. And this is the way he sees that actually getting accomplished. You may love it, you may hate it, but it's what's happening. All right. And then tech stocks. This is the major growth area of the stock market. And when it goes down, the market goes down. And then we're still seeing this rotation. We were seeing some signs of hope earlier in the week that maybe growth was starting to make a comeback. No, that got wiped out on Friday. And we're seeing value starting to, or continuing to, I should say, show strength along the way here. And that's what the market does when it's getting ready to be defensive, which means it's getting ready to go down. We're seeing some things that are very similar to what we saw starting to be played out at the end of 2021, which led into the cyclical bear market of 2022. But we're not quite there yet, and we're still above some support levels. There are folks, you could probably watch other videos on YouTube that are just sure we're crashing from here. Other folks you listen to say that, well, things are still looking okay, but we need to weigh the evidence as it's presented to us and say, is it turning more positive or is it turning more negative? So for the week, the Dow was down 1%, the NASDAQ down 2.6%, the S&P was down 1.5%. And of course, small caps had to be down. They couldn't buck the trend there. They were down 1.6%. This is a chart I've been showing for quite a while now, and this is what the market's afraid of. We're still coming into this time somewhere in this dark blue area where inflation has been coming down. Well, the fear is that it's really going to spike up and back to what we saw in the mid to late 70s. That was really high inflation. In fact, we called it stagflation, where we had super high inflation, but no economic growth during that time. So it was really difficult to get out of that. Finally, once we got into the 80s, then Ronald Reagan became president. We saw that coming down. We actually had a double dip recession during that time where we went into a recession, came out of it, and then went back into a recession again. And if you liked Reagan, if you liked the 80s, if you were around then, there was some painful times. It didn't just magically become good overnight. It can take some time to work this stuff out. Now, we're still above that 4.02% level with a 10-year yield. And this is one of the reasons why earnings are coming down as far as their forecast because once we're above that level, we're at 4.23% right now. That starts biting into corporate profits. And that's why we're seeing this slowdown. Once we got up into the four range, you notice that's when things kind of started to level off and slow down, and the upward momentum started to really slow at that point. And that goes back into late 2024 as well. This has not been updated. It won't be updated until after the employment report comes out this coming Friday. But the last reading was that we saw long-term unemployment. This is over 6 months. This actually ticked down in the latest reading. Then some Isabel Net block charts. This is just showing truck sales. And you would think, when it's going up, that's a stronger economy. When it's going down, that's a weaker economy. We haven't really been doing all that much. We're just kind of chopping around, not really showing any conviction. And then realized and consensus earnings per share for select U.S. equity indices. And here we have the S&P. And this gray area, that's 2023. That's already happened. And 2024 is now being completed here. And then we have it coming down here for 2025, but then more optimistic going out to 2026. Okay. And then here's the other indexes. The one that's kind of interesting is look at the forward projections for the small caps. That's the Russell 2000. I don't know, it seems kind of impossible now, but hey, anything can happen. And then the probability of a recession, it had been coming down. That's the red line. Now it's starting to go back up, but it's still not giving us a very high reading. Then since late February, the S&P is down about 5%, while the the 10-year yield is unchanged. And it just shows how they're both kind of around the same area. We actually got above the let's see, into February. This is when we were having trouble because we were above that 4.5% level with the 10-year yield. And when we started coming down with that as well. And now stocks, at least for right now, they're not as fixated on interest rates as they had been going back into February. But that could change at any time if interest rates really start to go back up. Then the trade war is at the top of the mind for investors. Out of all the things that people are freaking out about right now, it's the trade war that may throw us into a recession that seems to concern people. And then a rare moment for value stocks. This is part of the rotation that I keep talking about, where we're seeing money coming out of the growth areas, which helps the market go up. Well, we're seeing value doing better now and actually showing some improvement. And that's more of a defensive move that the market makes before it gets ready to go down. Okay, then just one post from FactSet here. And get this, industry analysts project a 21% increase in the S&P. Like a year from now, they expect the S&P to be up 21%. It seems impossible now, but much, much stranger things have happened. All right, so here's the intraday chart, and things were holding up okay throughout the week, but it was Friday. That's when we opened lower and just kept going and going and going. These are the pivot points I'm talking about. Now, I only plot S1, S2, R1, R2. That's all the software from stockcharts.com that I have. That's all they plot. These my goodness, blue dashed lines, I have to use a pivot point calculator. And when we're really coming down, I put this line on here myself. So it doesn't always show up in the charts that I post on the YouTube community tab, but it can be a good starting place since we spend most of the time never really going above S or below S2 and never really going above R2. So there are exceptions though, and if you are interested in the pivot point calculator that I use, I can just send me an email or leave a comment and I'll send you the link. It's a free calculator that you can use. So looking at the sectors just for the week, this is just the 5 trading days. I'm sorry, not the sectors, the indexes. All of the indexes ended up being down, led lower by the NASDAQ and NASDAQ 100. The NYSE was down, but it was down the least. Now, this goes back to the beginning of the year where we still see the NYSE holding on to some gains there, where all of the other indexes are now down year to date. Now we look at the sectors, and this is sorted by how much they declined. And this is tech, communication, And then down here is discretionary, which was virtually unchanged. But these top two areas, they're growth areas. This is where the real strength of the market comes from, and they were down the most. And that's why we're seeing some of these other areas like real estate, energy, and staples. Those are defensive areas, and they were actually up on the week. And then over on the right-hand side, this is ranked according to how this sector performed over the last week, where we had energy, a defensive area. It's up into the 90s. Financials, communication did okay. I mean, it's not great, but it's respectable here. And then utilities, which can be another defensive area. Some folks argue that maybe this is a growth area now with all the additional electricity that's going to be needed for AI and for electric vehicles and for crypto mining and all of that. Maybe that's a growth area, but typically it's been one of those more conservative areas for widows and orphans because they usually pay really well with dividends. And then the weakest area down here coming in at 6. This is a scale of 0 to 100. Okay, tech came in with a score of 6. This we need this to be at the top and up strong. That's when the market is really doing well. Then looking at the sectors just for the 5 trading days, where we see tech and discretionary down, and going back to the beginning of the year, tech and discretionary are down, where the other sectors are now positive year to date, with energy right now doing the best. This is the relative rotation graph, the green area. If you remember back to geometry, the x-axis and the y-axis over here in green, that's plus plus because we're above the x-axis and to the right of the y-axis. So we see, and now this goes over the last year. It's not just the last week or the last month. I just go through this over the last year, where we do see financials looking a little better, communication looking a little better here, but we're really seeing the discretionary sector. That's yellow and going down. That's negative. The one other area is tech. That's red and going down, where we're seeing a lot of rotation and some improvement with some of these other sectors. And this looks at it a little different way. The green areas are showing an improvement. The yellow area is more neutral and actually showing some weakness. The red area, that is negative, and that's tech. And then the blue areas, they're looking a little better, but they haven't really gone into the stronger part of the chart we just looked at. Then we look at the major indexes here, where the S&P is holding up about the best. It's green and kind of hanging into this plus plus area. That's because the S&P not only has growth, it also has value. There are 503 stocks that make up the S&P, and so it's more balanced. It's weighted to growth versus value. So it tends to underperform when like the NASDAQ 100 and the NASDAQ are going up because they're all growth, but it tends up to hold up a little better when we're going down, where the NASDAQ 100 and NASDAQ are going down faster. And so that's why this has been holding up lately. But we are seeing weakness with the OEX, that's the S&P 100, the biggest stocks that make up the S&P 500, the NASDAQ 100, and then a lot of these other areas are negative, where we're seeing utilities trying to show some improvement, and the Dow Jones Composite Average is also trying to improve. That takes the Dow, the transports, and the utilities together. And it's not getting its strength from the Dow lately. It's more that, or the transports, it's that utilities have been holding up a little bit better. This looks at it here, where really the best looking index according to this is the S&P 500. It hasn't been going up, and it's down almost 10% from its all-time high, but it's still looking a little better than the other indexes like the S&P 100 and NASDAQ 100. These red areas are negative, with the blue areas showing some improvement. Sentiment, we were able to get above that 25 level for a lot of the week last week. Well, we came down back below it. We just camped under here for a few weeks, and then we finally were starting to get up out of that. Friday's move sent us right back down here. And this is not normal. This is not what we usually see. We usually come down and then V bounce out of this. That's not happening this time, at least. And then the active asset managers, they're pretty much neutral right now, not really overly optimistic or pessimistic, coming in with a reading of 57.55. That's the same chart, just a different screenshot. And this could be positive, but it was also giving us a negative reading a week ago, and I said it could be positive then. These are the folks that make recommendations about whether the market's going to go up or down, and they have newsletters or websites. they're still coming in with a really strong negative score. We were able to climb back above one, but we were under one a week ago. And this could end up being positive because when they're all negative, it's like who else is left to sell? And sometimes we're able to bounce up out of that, but not yet. And the VIX, which spent a lot of the week under 20, is now back above 20, and that's negative on an annualized basis. This is also a concern when you compare cash to the tech sector. We're coming up into the red cloud. And this goes a little counterintuitive. When this black line's going down, that's actually positive. That means the tech sector is outperforming cash. Well, now it's starting to not outperform cash. And if this keeps going up, we could see what we saw back in 2022. This was the bear market. And we see this black line actually going up. We want this to turn and go back down to be more positive. If it continues to go up, that will be more negative. And the right X bear bull ratio, these folks are just getting whipsawed like crazy. We have a down day and they get into the bearish mutual fund. We have an up day, they get into the bullish mutual fund. And they're on the wrong day at the wrong time. So they're just kind of going back and forth crazy right now. And then this is interesting. For the fifth week now, we've had the individual investor survey come in under 50. Now, there's another chart that I showed earlier in the week that says when that happens, we have a perfect track record with very strong returns going forward. And that may happen, but I wouldn't base it just off of this chart because we've been camped down here for 5 weeks. And so there's a chance when it gets to be a really negative reading, that's when we use it as a contrarian indicator. And the Ulcer Index, this is another fear gauge mainly for mutual funds. It's starting to go up above the moving average. We're keeping an eye on the spread between risky and not as risky bonds. It's a little more evident here, only I inverted the scale where when this is going down, that means fear is going up. And we started to show some improvement, but now we're coming back down. If this continues to fall, that's going to be more negative. And I use this more as a sentiment gauge of the bond market. And we look at the VIX and then the 3-month ratio of the VIX ticked down a little bit, but for the most part, the VIX has been outperforming its 3-month average. That means it's moving pretty fast and it's going up. So that's why we're seeing this red line going up as well. We're still hanging out okay with our long-term equity put call ratio moving average here. It hasn't started to go up yet, but it is leveling off. If it turns and goes up, that would be more negative. Then the national financial conditions, we're still under this black line here. That's showing that there's no problem. We only get concerned when it goes above the black line. This is a new chart, which really isn't helping us all that much, but I want to start including it. It's a weekly economic index, and it's not really freaking out at this time, according to this chart. And then we're still getting forecasts for negative GDP by looking at the Atlanta Fed GDP now. They drop down here. We're looking anywhere from over 2% decline to about 1.75%. And so they're predicting that we could possibly go into a recession. Now, a recession is when we have negative GDP for back-to-back quarters. So that'd be 6 months of negative GDP. And we'll have to see because you go to the New York Fed, they're projecting growth of 2.86%. They're not negative, they're positive. So we're getting some conflicting information here. This is the GDP now from the Atlanta Fed, where it's showing negative GDP for the first quarter of 2025. This has not been updated. It will be when the employment report comes out. This has not been updated either. And the chart that I do look at, this is much bigger and probably easier to see. We're not seeing that big of a change here. This is the smooth U.S. recession probabilities. We're still below the black line. We really get nervous if we go up to the red line. So right now, this is not showing any concern. This is a quarterly leading index, which will probably be updated now that we're coming to the end of the first quarter of 2025. And we'll see if it ends up coming down or it starts to go back up. When it's going up, that's more recessionary. Inflation, we did see an adjustment because we had the PCE and core PCE come out on Friday and actually went up to the upper end. It came in with the headline number, but because there's so many decimal places, it got rounded up to the expected number instead of rounded down, which is what we saw before. And it's actually making the annualized inflation rate get go up higher. And the market didn't like that. And that was part of the reason it really went down. We're looking at an 81.5% chance when the Fed meets on May 7th that they're going to keep rates right where they're at. And the market's pretty much locked into that. No rate changes. We're currently at 4.25 to 4.5. But this is interesting. We're actually seeing a little bit of an edge here now that they may cut rates after the June 18th meeting. But this is still far out. This is like, science fiction future stuff. There's so many things that could happen that could change this. We're just looking at it for what it is right now. And folks are still kind of hoping that there will be a rate cut because when the Fed met in their uh, report that they released, the SEP, Summary of Economic Projections, I think that's what it means. It's a newer report. They never used to put out anything like this. They're still thinking that by the end of 2025, the rate is going to be at 3.9%. Well, right now we're at 4.25 to 4.5. And in order for that to come down, that means at least one, maybe two rate cuts, probably two rate cuts. And so the market might be trying to front run this a little bit to see if that's actually going to happen. The Fed balance sheet is declining right now. And so they're seeing things falling off. And that's because it really went up during the whole COVID crash because the Fed did quantitative easing where they come in and they start buying bonds, something they promised they would never do. But now it's an expected thing if the market starts to run into trouble. Well, now they're trying to get rid of all those bonds that they sold. And during the last meeting, one of the Fed governors said, well, they're letting 25 billion a month fall off the balance sheet, and they decided to lower that to 5 billion a month. And that one Fed governor said, well, we need to keep it where it's at right now, but that was not the majority vote. This is also showing the year over year change of the Fed balance sheet. Kind of want to keep an eye on that one. And we're seeing a little bit of a spike up here. This is the overnight reverse repurchase agreements. If this keeps going up, that means something's happening with the banks. But we've seen little spikes before, and then things were under control soon after that. Now, when you look at the advanced decline line, both on the daily side and here on the weekly side, we're doing okay. We're still above these moving averages here, and we're holding up. Now, that could be because we're rotating from growth to value. It's not like money's going out of the market. It's like it's going from one part of the market to the other part of the market, and that's helping this internal measure actually hold up better. And we're seeing a similar thing with the new highs, new lows. We had some new highs generated and some new lows. We're still going up with the 4-week moving average, and we're starting to turn back up with the 10-week moving average. And we're seeing a little bit of a decline here with the advanced decline ratio. Short term is the blue line, more intermediate term is the red line. Now, this is short to intermediate term in the context of looking at weekly charts. So this is a 19-week moving average and a 39-week moving average. As far as our trend, we're negative here. The dark black line is the ADX. That's the main indicator. I put a moving average on here to give a little bit of context to see is it going up or down. We're above the moving average, so that means it's getting stronger, but it's not officially a trend until we get above 20. So that's just showing the condition of the trend. Where we get the positive and negative from are the red lines and the green lines, and the red line, even though it's coming down, is well above the green line. So this is a negative long-term trend. And we're seeing that on the daily side with the short and intermediate term daily charts that we look at there. So we're seeing across the board negative trends based on the ADX indicator. The Arun also measures the difference between buyers in green and sellers in red, and it's really dropping down below zero, so that's negative. We don't have a signal here with the mass index. We're waiting to see if one's going to be triggered on the daily side. When all of these criteria are met, it tries to signal that there will be a reversal. And we've been coming down, and so we'll see if that's going to produce some kind of an upward move, if we even get that signal. But we're not too far away from that happening. And it's a little hard to read here. This is a daily chart because now the pivot points for April are starting to be drawn. That's another cool thing about the pivot points. They're on the chart before we even get there. So you know these levels ahead of time, and this gives you things to watch out for. And coming down, seeing a little bit of weakness with the 50-week moving average here with the S&P 500, but we're still in a trend, both on the daily side and here on the weekly side, where the blue line's above the red line. Now, if we continue to show weakness, eventually this blue line is going to come down and cross below the red line. That would signal a long-term downtrend, but for right now, it's still in an uptrend. And then this is something that I picked out at the end of 2024. I've been using this chart for years now, but we hit the upper end of this trend channel, and that's just about the time we started to lose that upward momentum. We had enough in February to kick us into a new all-time high, but we're pretty close to this line, and then that's when we started to see the problems develop. This is still positive for right now. A weekly chart of the S&P, we closed 5 points or 5 or 6, depending how you round things, above this pivot point. And this is very significant. We already came down here and tested this before, even though we fell through it. If we fall down below this, and this is at the 55.81 level, if we look to close down below this, that's going to turn things negative because this is a major support level that so far has been holding. And we're still looking good here with the accumulation distribution. I shouldn't say good. It's coming down, but we're still above the moving average. And believe it or not, we're still seeing that on the daily charts. And that could be because we're seeing rotation. Instead of money coming out of the market, it's going from offensive to defensive areas in the market. This is negative though. The chicken money flow, even though it's green, it's coming down and the red line's going down. So this first chart here, this is smart money indicator number one. This is smart money indicator number two, the chicken money flow, that's negative. So we have one positive and one negative, and I define positive here. Are we above the moving average? And yes, we are. This one's negative because the red line's going down. And this is the chicken oscillator, which is also declining and coming back down to the midpoint. So 2 out of our 3 smart money indicators are negative. We're below zero and declining with the McClellan oscillator. We're ticked up a little bit here with the summation index based on price, coming back up, but right about at the midpoint based on volume. And a lot of this action that's taking place not only on the daily side, but here on the weekly side, it's right around the midpoint here because the market is really lacking conviction. We have a couple of good up days and then a couple of down days and a couple of up days and so it's kind of confusing these indicators. They're trying to find some kind of a trend, but when most of the results are around the midpoint, that's showing that there's not a lot of conviction. We did decline, but we're still positive based on price, and we're falling below based on volume when we look at the Swinland trading oscillator, and it's also negative on the daily side. This was looking better for much of the week, the bullish percent index, but then we came back down and closed at the low in Friday's session. So now it's turned negative on the daily side and showing some weakness here on the weekly chart. Then we look at momentum, which is rolling over with the PMO, coming down below the midpoint based on price and volume here. And with the studies that go along with this, we're seeing a bit of a decline with the PMOs that are rising, but the buy signals are still going up, and we're level to starting to turn up with the PMOs that are above zero inside the S&P. And this I pointed out a week ago because this could have been positive. So far it's been a big nothing burger. We closed down below the lower Bollinger Band, and that's what this percent B indicator measures. But we're still right about here. We haven't really changed. And momentum, though, is still negative. And we're positive on the daily side. We're seeing some weakness, but we're still looking good on the daily side, where everything over here on the weekly side continues to be negative. The Copic curve is negative or it's positive on the daily chart. We're negative with the force index here. We're also negative on the daily chart after Friday. We're below 50 and declining with the money flow. We're also negative on the daily side. The rate of change, we had a down week, so week over week. That's why we're below zero. And we actually ticked up just a little bit here with the rate of change going back 50 weeks. This is long term. We're negative on the daily special K chart. We're rolling over, but we're still positive here on the weekly special K chart. And we're below 50 and declining with the RSI based on 14 weeks. We're extreme negative, but we could stay down here for a while with the Stochc RSI. We're just starting to get extreme negative with the Williams percent R, and it can stay down there for a while too. The vortex is negative, even though the red line came down and the green line came up. The red line is still above the green line, so that's negative. We're below 50 with the ultimate oscillator, and we're below this 40-week moving average here. We're just continuing to break support, at least for right now. We're negative with the hike in Ashi. These are all black candles. That's negative. We're actually negative with the Keiki chart, but pointing up. It's red. That's negative, but pointing up means a positive slant to it. We're negative with the Renko chart with the red block, and we're negative with the three-line break chart as well. So the trend is more negative currently. We earlier in the week we had enough of an upward move where we actually draw in a new X. Now we're seeing some new O's drawn in on the daily point and figure chart, but this is actually looking a little bit better here, but we don't have any kind of a signal that's been found with this chart. And we're trying to improve, but still below zero with the ease of movement going back 14 weeks. Looking at our longer term momentum, seeing it going down, we're negative now in the intermediate term. We were starting to bounce back up in the short term, but then Friday took us back down and we're below zero there. And we're negative with the Elder's Impulse system for the S&P. We're negative with the parabolic SAR for 4 weeks now. The dots have been on top. When the dots are underneath, that's when it's positive. And this really hasn't changed. Still negative in the short and intermediate term with the S&P, mid caps, small caps, and NASDAQ 100. And we're negative with bonds in the short term, positive in the intermediate term, and negative in the long term. We're commodities, and this is where some of the inflation fears are coming from. On all time frames, commodities are positive, and this is aluminum, corn, wheat, gas, oil, all the things that people need to live, and those prices could be going up, which ultimately may come through to consumers as higher prices, and that's where you get inflation. Where the dollar is still in a downtrend in the short and intermediate term. And this is just looking at the different indexes, but not putting anything on here. Well, we've been showing some weakness with the S&P, a little bit more weakness here with the mid caps, and even more weakness here with the small caps. The Dow still in an uptrend, but dealing with its 50-week moving average here. So we're losing some support there. And you're going to see a lot of the same thing. The NASDAQ below its 50-week moving average, but still in an uptrend. And the NASDAQ 100, same thing, below its 50-week moving average, but still in an uptrend. The mid caps, this is getting close to a death cross here. And we're getting close to a death cross on the daily side. And this could be negative. Small caps are already in a downtrend, and I look at two different small cap indexes on the daily side, the S&P 600 and the Russell 2000 small caps, and this is starting to come down and give us a death cross. We already had a death cross with the small caps on the daily side, and this would just confirm that. But you can see, just because we cross over to a downtrend doesn't mean it's going to always stay that way. What quite often happens is we see a crossover with the moving averages, and then we see a move in the opposite direction, just to make it even more confusing. This is a daily chart of the Wilshire 5000 falling further below its 200-day moving average. The NYC actually hasn't really come down to its 50-week moving average, and this index has been holding up better. All stocks, which takes US and world stocks into account, and world stocks have actually been outperforming US stocks, but still we're seeing some weakness here coming down to the 50-week moving average. The FANG index is pretty much gone under its 50-week moving average. These are really big stocks. And ARC is down around its 50-week moving average. And the banks, we want to keep an eye on that to see if anything's really falling apart in one of the financial sector areas. But we're below 50 with the RSI. We're negative with the momentum here with the KBW Bank Index. And then for March, going back to 2021, we've been up 80% of the time with a return of 1.6%. We're going to have a monster day on Friday to make it positive. And then this is traditional Dow theory, where we've been seeing the Dow under pressure. The transports are even under more pressure, where the utilities have been going sideways. And then some broad market measures here. This is a weekly chart of the CRB index, which are commodities. We're in an uptrend on the daily side, and we're in an uptrend here on the weekly side. And these are the different areas: energy, agriculture, precious metals, and industrial metals. With those going up, that could be inflationary. And that's one of the problems or one of the concerns that folks are having, where it's not really coming from oil. We're still under 70 with the price of oil, but I look at that more for geopolitical reasons. But then again, here is like a total contradiction to what's going on. Copper is used as a barometer for the economy. And when copper is going up, that means that the copper market, anyway, is anticipating things looking better into the future. And this is coming off setting an all-time high here. You figure that one out. Because copper is used to produce a lot of things. I know there's silicon too, but there's still the need for copper. But if this chart was concerned about the economy, we would be going down, not up. So that's a bit of a contradiction from what we're seeing. The dollar is still in an uptrend, but underneath its 50-week moving average here, and it's also under pressure on the daily side. Gold is coming off setting a recent all-time high. Silver starting to break out, but not at an all-time high, at least yet. Then we look at the total bond ETF. These are bond prices, and they are in an uptrend here. Then we're going to get this kicking over into April now because this is a monthly chart. And for the first time in quite a while, we're actually starting to fall below the blue line, which is a 10-month moving average. This is a daily chart of yields where they had been coming down. Now we're just kind of chopping around sideways here. And then this is a weekly chart, and I've been trying to point out this red line, which is the 10-year yield in Japan, because that's what produced all the problems last summer. Well, I guess the market has other things to freak out about now to make it go down rather than what the 10-year yield is doing in Japan. And then we look at all the different markets. And going back to the beginning of 2025, gold is still doing the best, followed by the price of bonds. After being really bad in 2022, 2023, 2024, they're actually positive year to date. Oil started to go positive, but now is right back down to zero. And then we have the dollar. And then in last place are stocks. They're the ones underperforming the most currently. Then we look at some ratios, the NASDAQ 100, which has been under pressure, and the S&P 500, which has been under pressure. When this is going down, that means the NASDAQ 100 is actually underperforming the S&P 500 longer term. The S&P 100 longer term is in an uptrend, but shorter term, it's underperforming the rest of the S&P 500. Growth versus value, we want growth to outperform. It's still in an uptrend, but lately it's really been pulling back, meaning value has been outperforming. And then the S&P has been going down, gold's been going up. So we're seeing a real spike up with this ratio. And we're starting to climb above this red line when we look at bonds to the S&P. For the last few years, this green line has been below these moving averages. Now it's starting to break out above them. And that could be turning things more negative. And then the dollar's been going down, gold's been going up. So that's why we're seeing this ratio going up here. Low volatility stocks. These are the ones that are more defensive. Toilet paper, toothpaste, the things that people have to have no matter what's going on in the economy. When this is going down, that means the low volatility defensive areas are underperforming the S&P itself. Well, look how it's really spiking up here, enough to give us a golden cross with this ratio. This could be longer term negative. Because if you go back to 2022, see, this was in an uptrend here. And if this starts to go into an uptrend, are we going to see something happen like we saw in 2022, where this ratio went up as the S&P was going down? Discretionary, another growth area compared to staples, still in an uptrend with discretionary, but coming back and falling below the moving average. This is energy to tech, where energy had been underperforming the tech sector. Now it's starting to break out to the upside. We might generate a golden cross here if this keeps going up. That would also mean things are turning more defensive. And the small caps, which have been doing terrible, and the tech sector, which hasn't been doing well, means this ratio is pretty much going sideways right now. And then some long-term studies here. Nothing really to see with the NYSE breadth thrust or the SWAG NYSE breadth thrust. We're still above this line going back to the 1987 crash. This is a weekly chart of the S&P 500. This is a further blow up. And if we come down here, I'll extend. I keep saying that in every video. But if we don't come down here, then I haven't taken the time to extend that line out. Now, this is still positive for the time being, but this could change at any time too if we see more weakness. The Zahorchak method, when we're getting a reading of 10 all the way at the top, that's a full-on buy signal. If we go all the way down to minus 10, that's a full-on sell signal. And we've been riding this buy signal for quite some time now. But if this starts to drop, naturally that's going to be more negative. We're below this trend line going back to 2009 with the NASDAQ 100 as it's been under pressure. But this is holding up. We look at the NASDAQ 100, which is growth, and compare it to the Dow, which is considered to be value, even though NVIDIA and Microsoft, they're in the Dow. But we're just down to this red line again. This ratio is not falling apart. And a similar thing here. It's not that the Qs, which is the NASDAQ 100, are doing all that well. It's that the small caps are really not doing well. And so we're seeing this ratio still quite high. New highs, new lows. We're dropping below zero for the NYSE. We're also dropping with the new highs, new lows for the S&P 500, but we're still above zero. And we're just going sideways now with the 3-month yield here. And we're seeing some weakness lately with the NASDAQ cumulative new highs minus the new lows. Then seasonality, the market's going to have a really good day on Monday to get back to what's been happening. It's usually up 65% of the time. Maybe this is going to be the 35% of the time that it's not up, with the average return of 1%. And this is also going to be the end of the quarter as well. And then November to April is supposed to be the most positive time for stocks. We're up 77% of the time with a return of 7.1%. Market's going to have to do a lot of making up to get back to that. And then we're finally finishing out with the second half of March. If we look over to April, the second half looks pretty good. And then the first half also looks pretty good as well. But the first half of March looked really good and it did terrible. All right, and then the first quarter is going to be ending, so this will be the last time I show this chart. Usually after an election year, the first quarter can often be negative or just lack of positive. And then this is a composite, but we're like down here. We're down minus 9% or so. We're kind of off the chart to the downside. We're wondering if we're going to get a bit of an upward move and then see some positive action after this. And this is because new things are happening. It's not business as usual. Or as some people say, there's a new sheriff in town and there's a lot of changes. And it's going to produce some upheaval in the markets. And it's also going to produce some upheaval with people's confidence in things. And then, yeah, right. The second half tends to be green. Well, good luck with that one for March. And this is the Hindenburg Ullman. You can stop and pause this if this is new to you. But what we need is a second spike by the time Monday is over. We have one more day. We have March 31st. If we don't get a second spike here, then this is going to fall off the chart and no longer be a signal. Hindenburg, that's a very negative name. You can see other times this was triggered. It was right before the COVID crash and right at the end of 2021. Now, it could still happen because of what happened in Friday's session. So we'll see. So thank you. I hope you found this helpful. I hope you're having a wonderful weekend, and I will talk to you in the next video.